the big debate for us is, how do you value Tesla? How do you see it? How do you determine what a fair stock price is? Um, and so you have a very fun, or kind of a very holistic approach of how you do this. Please share that with folks.
So we have two car companies that will survive, Tesla and Toyota. Tesla's obviously got a much bigger valuation, 700 instead of 300. The incremental $400 billion, very simply, is the value of autonomous driving. It is recognizing that Tesla has made tremendous strides in autonomous vehicle technology and will continue to make more. And it's the assumption that there is some, what I would call, call option value, not an equity value per se, but a call option value on Tesla becoming the premier provider, or a premier provider, of autonomous vehicle technology.
If you day trade Tesla, you probably love the volatility of the stock. The swings up and down are many factors more than its beta suggests, so if you're trying to capture a move in the market, doing it with Tesla stock can be much more lucrative than trading any other liquid names like the S&P 500 and NASDAQ tracking ETFs, the SPY and QQQ. But if you're a long-term investor and you're watching this video, you might be like the many types of Tesla fans that I see that can't help but watch the price action of the stock every single day. Perhaps you're all in on the company and 100% of your money in your brokerage is just in Tesla stock, or maybe your whole retirement is Tesla stock as well. In that case, I can understand a little bit why these daily movements could be important to you. Some Tesla community members would say they don't watch short-term price action, and they tell you shouldn't care what the stock does in 1 or 2 days. But somehow, they always know what the stock is doing, especially if it's going down. Regardless, volatility can be hard to stomach, especially when your life savings are invested in the company or you're incredibly leveraged in your Tesla position. In the last year, we've seen the stock drop over 70% from its high and then go up 190% in 190 days. It's great that it went up, but it's still well off its high even after doubling in a few months. So what should you do? Well, you can pretend like the stock market doesn't exist and believe in Tesla's mission, and then eventually it'll be fulfilled. But I think if you're watching this video, you don't quite fall into that camp. What you might want to do is reorient the way you look at your Tesla position. One way to do that is see Tesla like how Nick Kolas does. He and Herbert Ong were in the opening clip of this video, and they discuss how you value Tesla as a company. And he proposes an idea that the value is tied up in a bet that Tesla will solve autonomy, full self-driving, and AI. Now that bet is, like how he explains it, more of a call value instead of an equity value. And by call, I mean a call option. Instead of looking at one share of Tesla as owning a portion of the company, look at each and every share you have as a literal call option on Tesla, figuring out how to make their cars drive themselves. And this brings us to one way to handle Tesla volatility is to not leverage your position. Meaning, if you have a bunch of shares, don't own a bunch of shares and a bunch of leap options. You hear that term tossed around the community a lot, leap options, or how I see them as just really long dated calls in the hopes that Tesla can pop in a few years and you think you don't have to manage the option because of its long expiration. But if you can convince yourself that a share of Tesla is an option on Tesla solving autonomy, well, a leap option is really just a super leveraged position and exposing yourself to much more volatility than what is really necessary. Because any call option on Tesla becomes an option on an option. When Tesla became profitable some years back, it was kind of like a perfect storm of the advent of retail option trading, high retail investor interest in Tesla stock, and money that was being printed by the government for pandemic lockdowns. Returns were substantial, and I think it left this imprint in people's memory of the effectiveness of options. But replicating such a complex series of events in macro conditions, it's likely not going to happen again. The event you need to happen is autonomy, but let's put that aside just for a moment and touch on something I said earlier, and that is the idea that people don't have to manage a leap option. It seems that people think you buy a handful of leaps and then it will eventually work itself out. Easy money. Well, if you bought leap options over the last handful of years, you might be hurting. And a way to try to handle Tesla's volatility with leap options is to say to yourself, whenever you deal with options, be it buying or selling them, you have to manage it. And by managing it, you have to accept that you are now trading instead of investing. And if you're a Tesla trader, you're in for a whole new world of looking at the stock, and maybe you don't have time to learn the technicals of trading. If it's daunting for you, that's great, because you won't buy any more leaps, hopefully. But if you empower yourself and learn to trade on technicals, you can better learn to handle options of any expiration, because Tesla trades pretty cleanly. It'll predictably fall on earnings, and that fall can be around 15 to 25%, But when Tesla runs, it likes to do that with a gap up that doesn't fill, things like that. Now let's say I can't convince you not to buy leaps, and I can't convince you not to trade. Well, another way to handle Tesla volatility is to diversify your portfolio. And I know, diversify is a dirty word. Even Warren Buffett hates it. But hear me out. You're watching this video because you might have an issue with being on the Tesla roller coaster. So let's say Tesla shares are Tesla options, and buying a Tesla call option is like a super double leveraged Tesla play. If that's the case, then having a bunch of Tesla leaps is crazy high exposure within itself, especially for the amount of money you invested into it. Maybe it's better for you to own index tracking ETFs and Tesla leap options, so you can try to have the best of both worlds. What does that look like, you ask? It's pretty simple. For every 100 shares of Tesla you have, you can sell them all, then buy one leap, then use the rest of the proceeds to buy SPY, for instance. The current furthest expiry for a Tesla call is January 16th of 2026, and it would cost around $2,050, with Tesla being priced at $207 a share at the time of this video's recording. You would then use $18,650 to buy into the less volatile SPY. What could a theoretical return on such a position look like? Let's pretend Tesla will be worth 50% more by the end of 2024, and the SPY return 12% in the same time, which is the average yearly return over the last 10 years. According to this options profit calculator, your leap would increase in value by $2,500, and your SPY position would gain $2,238 for a total of $4,738. If you were all in on Tesla shares, it would be roughly double that return, but also you could be down 50% instead. But why, you might ask, is Tesla so volatile in the first place? This video is about a way to understand Tesla share price volatility and not really the fundamentals of the company, but I think if you can wrap your head around the concept, if Tesla was a car manufacturer, it would be maybe valued as the best car manufacturer in the world. Sure, but what price-to-earnings multiple would you apply to such a company? Well, let's look at BYD. It trades at around a 26 PE ratio, and many consider it a rival to Tesla in the EV space, but it also equally has a large amount of hybrid car sales as well. They're growing rapidly and cater to markets Tesla can't touch by region or price, for now. BYD has no real technology play, as I outlined in another video, so you can assume the market values this company as a volume leader that may become the next Toyota. They're just a car maker. Tesla, on the other hand, trades at a PE ratio of 67, or around 2.5 times that of BYD. So let's say Tesla is just a car company with a little bit of energy storage on the side. Maybe in that scenario, its market cap would be half of what it is today, and then the shares would trade around $104 each, or essentially the market capitalization of Toyota. And no, Toyota prints much more profit than Tesla does, like 2 or 3 times more per quarter, and it has 3 times the cash on hand. But I digress. With that concept out of the way though, once again, look at each share of Tesla as a bet or a gamble that they figure out autonomy, and you can start to come out to this idea that the rest of the value, say everything over $300 billion in market capitalization, is a bet that their research and development pans out. That puts a floor on the stock of around $100. As long as the stock is above that, it's going to be insanely volatile, as investors, traders, and institutions try to figure out what the real value and potential of the company in the future is, and all of this is done in different timeframes. For a retail investor, you might tell me, you're looking at 10 years out at least, and whenever the moment comes, when artificial general intelligence is realized, then Tesla stock will 10x in a matter of months. And honestly, I'm in no disagreement with you. But if you're managing other people's money, you have to answer to them, and you have to convince them why you are or why you aren't in Tesla. It's a totally different situation. You and I, we don't have to answer to anyone, and no one will care if we have unrealized losses if Tesla stock was to tank tomorrow. But if your job depended on Tesla performing because you're a fund manager at some big bank, swinging for a home run can cost you your job. If you run your own fund like Rob Barron, it would be a bit easier, but remember, Tesla was a small position in his mutual fund before it exploded in value 15 times over. As time ticks by, big money and institutional types will get FSD fatigue, where the promises on delivering on autonomy are pushed out from one year to the next, and the bet they're making on Tesla starts becoming an opportunity cost. For example, if you bought Tesla in January of 2021, you would have lost money since then, while the S&P 500 would have returned over 9%. How about buying Tesla at the beginning of 2022, which was the start of a very volatile year for any security? Well, the S&P 500 would have lost you 13.7%. But if you're all in on Tesla from that point in time, you would have lost almost half of your investment. This is the opportunity cost I'm speaking of, and that is the volatility that you need to be okay with. Rob Barron started his position in the mid-2000 teens, and he had to hold his Tesla shares for about 4 years just to see it outperform the S&P 500. But what a lot of people don't talk about is, when Tesla's stock price broke out, it consolidated for almost 2 months, where thereafter it skyrocketed 168%. I bring this up because of this notion that you have to be pre-positioned in Tesla stock to capture this move, because it will never be this cheap again, they say. Well, that's not really what happened, because in 3 months the share price returned to right where it broke out from. It lost over half its value. So you didn't really miss out if you didn't buy the first time it broke out. And then do you remember in May of 2021, where it started to climb what seemed like nonstop for half a year, gaining 125% in value? Well, the price of Tesla stock right now is the same price as it was in May of 2021. And what about that artificial intelligence euphoria we just experienced? We're just 20% away from hitting those same prices from spring of this year. The concept of being pre-positioned, it's not really a thing. The reason for that is because the interest that traders have in this ticker of ours. Say something incredible happens, like in June of 2020, where Tesla moves 20% in 2 days. Ask yourself, would you buy more stock after Tesla just went up that much? A lot of people wouldn't, or simply couldn't. Not everyone is sitting on millions of dollars in cash ready to jump in the market, but you know who is? Traders and institutions. Put yourself in another situation. When Nvidia jumped 20% after its earnings in May, would you have bought more shares on that day? If you wouldn't, or if I wouldn't, why did the stock keep going up? Almost half a year later, you'd still be okay if you bought on the day after earnings. Yeah, we wouldn't have bought, but the share price kept increasing. People on Twitter or people in your Discord communities might say, who are the dopes buying Nvidia at $390 a share? Yet it still went up. It would be sort of delusional if you think retail investors are pushing that stock up. It was big money or smarter money. What they're doing is they're trading the breakout, hoping to get in on a move that might not stop for some time. It's a strategy you might want to look into because there are plenty of breakouts in Tesla's history that were buyable. Like I mentioned a few minutes ago, the June 2020 pump. If you would have bought Tesla after it jumped 20%, your position would have increased 288% in 6 months. At that point, I don't think you'd be thinking about that 20% move you missed when the stock broke out. 308% versus 280%, it's the same thing. At the end of the day, if volatility is a concern, just note Tesla has phases of consolidation that last years, and in those consolidations, prices can swing wildly even though it's stuck in a range. If you look at the time from when the stock IPO'd to when it broke out of its first consolidation, it took 700 days, and yet it looks like such a tight range. But in reality, those swings were up and down 70 to 80%. Then for another 3 years, it zoomed up 150%, then down 50%, then up 50%, until breaking out yet again. It would be trading sideways, but a violent sideways for 1100 days until it made new highs at the end of 2019. And here we are in 2023, where we saw lows that equal share prices in July of 2020 that were 75% off of our all-time highs. If history repeats itself, these peaks and valleys will look minuscule in a year or two perhaps, but even if Tesla becomes a multi-trillion-dollar company in that time, volatility is here to stay, and the only way to avoid it is to lower your exposure or get off the roller coaster completely.